Afternoon, everybody. Thanks for joining our September webinar, Macro Market Updates. Our host is Carl Grund, an independent financial advisor, consultant, and works a lot with select entrepreneurs and small to mid-sized business. Our panelist today is, I'm sorry, Jack, I did not get the pronunciation of your last name before I started. But Jack is a portfolio manager and lead portfolio strategist, and responsible for providing insight and analysis on global economic and capital market themes. So take it away.
Thanks, Jack, for joining us today. So today, just for the folks on the call, what we're going to do is just talk about a 50,000-foot view of what's going on with the market, where Jack and his firm see opportunities. They certainly have relationships with a number of different fund managers, fund companies. So I think they can provide a lot of insight into where some of the opportunities are in the market. And then at the end, we'll turn it over for some questions if you guys have anything more directly that you want to speak about. Jack, I think everyone, when they turn on CNBC, CNN, or any news channel, the biggest thing right now is what the Federal Reserve is going to do, right? Where interest rates are going to go, and ultimately, how do we tame inflation? When you guys then, how are you guys approaching the management of portfolios when we're thinking about where interest rates are going and how the Fed's going to approach things? And more importantly, I guess, where do you see this going? Do we see that there's going to be a chance for a soft landing, or are we expecting, really more of a hard landing? And you guys in the camp, I'd say more of some of the bears out there, like I think Minard from Guggenheim came out this past week and called for a 20% drop in the market between now and October. So we'd love to get your guys' thoughts on how you're approaching, what's going on, and then really at a macro level, where you guys see the opportunity and, where you think things are going.
Sure. And again, thanks for giving me the chance to speak here, Carl. And, there's quite a bit to unpack in terms of those questions. And, I think maybe take a step back and sort of just think about how we got to this point, which is inflation at the headline level, close to 9% at the peak. And it was really just consecutive shocks, right? If you think about the COVID backdrop, the way China's been handling that COVID backdrop, which is their zero COVID policy. You've had the Russia-Ukraine war. You go on and on through the list of which seems to be one shock after another. I think independently, the economy probably would have been able to handle these things, but they seem to all blend together. And that blending of together, I think, is what's really caused this backdrop where we start to see inflation spiking up in here. So I would say a couple of things to think about and how we're thinking about things. We think of inflation, I think, in two different stages, right? Think of it as cyclical and structural. The cyclical stuff, think of that along the lines of like goods related inflation. And that's sort of the first leg I want to talk about, because I think that's the easiest one for us to sort of get our arms around, and also the easiest one for the Fed to sort of bring down. And, when you think about goods inflation, think about the supply chain disruptions, right? We spent a lot of time during COVID, and this kind of caught, I think, the market off guard. While we were in lockdown, right, the government was basically sending out all these stimulus checks. Unemployment benefits were upped. We were able to retain our spending power, right? Mm-hmm. But at the same time, a lot of the companies basically went into lockdown mode because the blueprint really was unsure of how to handle a pandemic. And basically most companies said, we're going to treat it like a pure recession. So they basically started to shut down. So consumption basically kept everybody spending. At the same time, all these companies started to shut down. You had a pretty significant supply and demand imbalance there, right? Plenty of demand, but not enough supply. And hence, you get supply shortages. The equilibrium clearing price has to move higher. Econ 101, that's where we basically are at the start of this year. What starts to happen, though, a lot of these companies end up double booking, over ordering, padding their orders because they expect to get shorted when they actually get delivery. And guess what happens? Supply chains start to ease up a little bit. You start to get a little bit of the export sector coming out of China easing up, even though they have zero COVID policies in place. And all of a sudden, you've heard this over the last couple of quarters from a lot of the big retailers here in the U.S. but all of a sudden they're sitting on excess inventory of stuff. And all of this is happening at the same time when consumers are actually shifting gears, right? We're shifting away from buying stuff because that's what we basically did during COVID. We want to get out and about and do things. So think of those as experiences, right? The services side of the equation. So you've got this big mismatch in terms of the supply and demand, and all of a sudden it's being compensated for, it's being overcome. And at the same time, now we have the consumer zigzagging. So how do you get rid of that excess inventory? And you heard it from the Targets, the Walmarts, the Home Depots. You go through all the big box retailers. They're going to have to start cutting prices to ease up inventory. That's the easy part of this equation. That's sort of that cyclical component that I was sort of referring to. We're already starting to see that come through. You're starting to see prices drop, and you're starting to see a lot of the things that basically I think were pushing prices higher in the midst of COVID. Those are actually starting to retreat again. And so if you sort of think about the first stage of inflation coming down, that's the easy part. And that's sort of what we're talking about right now. And you could probably lump in a little bit of things that are close to what's adversely impacted by higher interest rates. And you're seeing it, for example, in gasoline prices. Those are starting to come down. That first leg, that cyclical portion, that's the easy part. The harder part, and this is where I think it gets a little bit more interesting, it's the structural part. And the structural part is really going to be a function of the labor markets. And why do I say it this way? Going into the start of the year, we thought the labor market was going to be pretty, much more robust than I think the most people were giving it credit for. And that was going to be our sort of bull case scenario, why the U.S. economy would avoid a recession. It's actually proving to be maybe even more resilient than we expected. And as a result, that resiliency is probably at the heart of this sort of the structural component of inflation, which is going to be, I think, the harder piece to get lower, simply because if people are still employed, they have money to spend, they're going to spend it. That aggregate demand, I think, is what's keeping price pressures, I think, elevated in the interim. So how do you slow that down? And the Fed is trying to do this. You need to slow aggregate demand down. How do you do that? Well, you basically have to force the unemployment rate up. And we've already seen almost 250 basis points worth of tightening in Fed policy. The unemployment rate really hasn't moved anywhere, and you're not really seeing huge signs of layoffs coming. And that's how strong, that's how robust the labor markets are. And so the cyclical portion of inflation, pretty easy, and we're already seeing that start to manifest. The structural side, that's going to be related to the labor market. That's going to be trickier. And so if we sort of tie all this back to the idea of, can we get a soft landing in here? It's going to be a function of the labor market and how aggressive do these rate hikes start to work their way through the labor market. And if they start to get through and really start to adversely impact the labor market in a very aggressive way, that I think is going to make it even more challenging to sort of thread that needle and get us to a soft landing. So the labor market's the key. We still see signs of it being robust. I would say one last point in here. When we think about the labor market, think about it from a supply and demand perspective, right? A couple of interesting stats for us. If we look at where we were going into COVID versus where we are today, there's still about 6.5 million people that have not re-entered the labor force. So how do we get sort of that wage pressure to come down a bit? Well, you can increase the supply of the labor market, get more people back to work. There's still plenty of people out there that can come back to work. They're choosing to do so for various reasons. Get them back into the labor force. Or the other side is the demand side, right? Let's push demand lower. And that's what the Fed is trying to do here with interest rate increases. And that's going to be the trick. So we're a little bit still optimistic in here that the labor market will start to soften up and we don't need to force us into a hard recession. But day by day, it certainly looks like the odds are increasing that maybe a harder recession as opposed to maybe a soft and mild one. It might end up being the base case scenario. And I think that's the trick that we're paying attention to. So all comes down to the labor market here right now. How much do we have to push up that unemployment rate to get inflation to sort of roll over? And that's that structural component that I was sort of alluding to. That's going to be quite challenging, I think, for the Fed.
No, that's really helpful. So I guess my takeaway from that is with the amount of just open jobs, how do you really get to an unemployment rate that high? Just because, you look, I think I showed a stat the other day. There's 2 million tech jobs that are open, right now. Yep. Is there a chance that really just them by, they're trying to shock the demand side, but it seems that, I think really you just have to work through the system. Is there a chance that they just keep raising and it really doesn't do the shock that they ultimately want?
Yeah, and in that the number you just highlighted, I'll actually throw another one in. The Census Bureau does a survey that goes out every 2 weeks, and they ask if you're not at work. It gives you, I don't know, I think there's like 10 different answers you can check the box to, and what's interesting, those answers, 2 of those are I'm not at work because I have COVID, and the other one is I'm not at work because I'm taking care of somebody who has COVID. Add up those 2 boxes. There's over 4 million people that are still saying they're not at work because of either one of those situations. So, if we can kind of get this health pandemic sort of in the rearview mirror and get these people back to the office, that's 4 million plus people that are saying COVID related issues are keeping them out. So to your point, there is excess out there that simply on the health side can come back into the labor market. And I think a lot of the wage pressures that we're seeing are in those service related portions of the economy, because those are the forward facing people with the public, and they're the ones who are most exposed to those health risks. They're a little bit slow and a little bit, I think, hesitant to come back. And that's one of the bigger sticking points. So, there's a supply issue here that's out there. You just got to entice some of these people back into the office place, and some of that's just the healthcare issue.
Well, as of Sunday, we were told that COVID was over, so we may be okay there. Tough one to call.
Sure.
Yeah, I guess one of the things that, myself and, a lot of advisors obviously are looking at is really how far do we expect them to continue to raise rates to kind of tame the demand? And then where do you guys see that equilibrium? Is if we get above 4.5, does that become a scenario where, we're expecting the market to drop 20% or whatever it is? How do you guys think about that? Are you guys charting kind of the percentage on where they're raising it to say, hey, if at this 4%, we're expecting, base case of X multiple, which puts the S&P at 3,600, 3,800. How are you guys thinking about that? Are you guys trading more on the fundamentals of the market and the fact that, hey, the labor market's strong, the consumer is still strong? So I maybe unpack that a little bit, from your guys' perspective.
And I think there's a combination there of how we think about things. It's fundamental and technical. The Fed has a couple levers to pull when we think about interest rates, right? How aggressive do we want the rate cuts to be? How fast do we want those to go through the system? And then how long do we keep them at a sustained level? And I think what we're seeing now is the Fed is moving more towards that latter component there. We're getting closer to what they would consider to be a restrictive level. And, they've really come out and with a full court marketing press here and basically saying it's going to be higher for longer. The fact that they're shifting a little bit away from aggressive rate hikes and large rate hikes to probably more sustained ones over the near term. And again, when I say that, I'm talking about the November, December meetings here. I think the meeting tomorrow, 75 is a foregone conclusion. But after that, if you look at what the market's pricing in for expectations when you look at interest rate forwards, it's more along the lines of a 50 and then a 25. But the point being, I think these large moves are going to be a thing of the past. And now it's going to be a question of how long are they going to stay in that restrictive zone? And the other thing I would point to, the market's discounted a lot of this. And what do I mean by that? Well, if I look out at what we call the terminal rate, right, that's sort of where we expect the rate hike cycle to stop and maintain for a little while. We're at about 4.5% right now. I would, back of the envelope calculation would say roughly 4 to 4.25 would be considered restrictive. So they're slightly restrictive. And if they stay with that higher for longer mentality, we probably stay at that 4.5% for quite some time. That's enough to probably start to finally get that slowing that we're talking about. So, the one thing I would say that they're trying to do, and this goes back to sort of trying to thread that needle, they could very easily push the rates aggressively up to something north of 5, let's say. And I think that would really slam the brakes on the economy. But at that point, you're risking an overshoot and pushing us into a certain recession. I think if they don't get quite to that elevated level, but we still are in a restrictive level, and we simply use duration as opposed to absolute level, I think that increases the odds that maybe we don't slip into a very challenged and hard recession. So if we're trying to play sort of the odds, that gives us, I think, a little bit of an opportunity to let the economic data come out. Maybe we start to see it slow. and the Fed can kind of sit at that 4.5 level and let things play out, and then they can adjust accordingly. Maybe they can pull back a little bit, or if they need to go even more so, you can fine tune that. And I think that gives them a little different perspective. But to your one of your points you made at the onset of that question, there's certainly an inverse relationship between rates and valuations. And if we just plot the PE of the stock market on the U.S. 2-year yield, pretty strong relationship there, and there's still a gap opening up. So point being here, the higher those rates have to crawl, that just means the market valuation has to come down. So, I'm hoping that terminal rate stays close to that 4.5%, because if it has to move up higher, the market's going to have to re-rate even more so, which means more downside pressure.
How are you guys looking at the market now? Are you guys at the current prices? Let's just say, assuming it goes to 4.5. I mean, you guys see this as fairly valued now, or do you guys see that there's some room for upside? Just based on assuming the 4.5.
Yeah, so this is about technicals versus fundamentals versus sentiment, right? If we go back in history and look at previous recession periods and just look at how much has the market sold off in those kind of environments, and we kind of break them into a typical recession, a mild one, and a severe one, a 25% equity drawdown tends to be a mild recession. So if we assume we go back to the June lows and sort of hold at that level, the market's discounting a mild recession. You get a little bit more closer to the low 30s if we're going on an average. And then obviously a severe recession, you're going to be pushing north of 50. So, if you're in the camp, as we are, that we're probably getting something close to a mild recession, you're getting close to equity level drawdowns here that are associated historically with that type of an environment. So you could argue that a retest of those June lows would fully discount that mild recession backdrop. Now, here's the catch. We haven't seen a ton of those earnings estimates start to be absorbed in terms of looking at that slowdown. And this is where I think there's a big split, right? The U.S. earnings backdrop has actually held up fairly well. We haven't heard a ton of revisions. Now, interestingly, FedEx the other night came out with some pretty bad news. I would say, based on what we've heard so far, FedEx is somewhat of a lone wolf in this category. We've heard plenty of other very highly economically sensitive areas of the market report, and they haven't been quite as dire as the FedEx numbers were. So I'm sort of discounting it a little bit, but FedEx is such a big player. I'm going to appreciate that there is something there to at least say, we better think about that one a bit. So listen, right now we're still in that mild recession camp. That also gives us a chance to say that, maybe those June lows will hold. Let's see how the earnings revisions go. If we have to see some more sharp reductions in those, we certainly could get something closer to maybe 3,300 on S&P. So maybe another 10% off of those June lows. But the other side of that's sort of the fundamental equation. The technical side, the sentiment side, positioning in the marketplace is very, very bearish. Sentiment with all of our clients and all sorts of other peripheral surveys that we pay attention to, some of these levels are below what we saw in 07, 08. And I think today's environment is not quite akin to 07, 08. So just to draw a little bit of a comparison as to how bearish the market is. So that gives us a little bit of pause to get too aggressive in terms of downside. Does that necessarily prove to be a contrarian point and push the market up? No, but it might say, can we draw down sharply from here? Well, if everybody's sort of already sold, who's left to do selling and who's left to push the market down? That sort of mentality. So you're trying to balance fundamentals with technicals and sentiment. And so that's why we continue to just hover around that June low. That'll be the key, I think, battle line to draw on there. So it'll be interesting in here, but you can certainly make the case for us to hold. And I think the earnings revisions would be the reason why we have to head even more south if that's the case.
Yeah, I mean, from a technical standpoint, I mean, it seems like we're almost in no man's land because we were trying to stay above 3,900. We broke that. And I guess the next point would be the prior lows in the 3,600 range, right?
Yep.
So I guess absent of positive news, I guess one would surmise that that's probably where we're heading, at least in the near term.
Yeah, I hate to say it, but our base case right now is that we migrate towards the June lows. And then there's going to be one heck of a battle there for a while.
Yeah, I mean, that seems to be the base case. But I guess from a positive standpoint, you guys hit the nail on the head as far as the 4.5 and the bearish nature of the market. So if things turn out to not be as bad, and the Fed can let their foot off the pedal a bit with the raises, I think there could be some opportunities to the upside.
And for us, again, it all comes down to the interest rate backdrop, right? The markets in the economy can handle higher rates to an extent. We just got to get used to it, but you got to give us time to digest that. And we haven't really settled into a point where rate volatility starts to come down, right? We continue to just drift higher. And I think until we can kind of get into a range where volatility starts to come down, that implied volatility on rates, that's what makes it a little bit more challenging for the market to sort of find its footing in here. So if the market gets comfortable at, let's say, 4.5 is that terminal rate, if the market can see rate volatility settling down, albeit at a higher level, it'll adjust, and that'll give us a chance, I think, to find that footing. But until we sort of get comfortable with, all right, where does the end of this rate hike cycle look to be? It's going to create some tough environments, I think, for the equity side of the market and risk taking in general.
Yeah, I mean, it seems like that's basically our conversation, U.S. market wise. Now let's shift a little bit more towards Europe and international markets. Obviously, the biggest theme right now is Russia, Ukraine. How are you guys thinking about, what's going to happen, as far as the war, and then how do you guys tie that into the market? Are you guys projecting a pretty bad recession in European markets? And then also, I think another big thing right now is just the rise in the dollar. How are you guys thinking about, how that's going to affect, I guess, Europe, and then we can transition to international markets?
Yeah, and if we take again sort of a step back, the beginning of the year, I don't think at least I didn't have Russia Ukraine as a key risk when I was writing my 2022 outlook. And then when you started to hear about the troop buildup, it was a bluff. Okay, and if they do end up invading, it's probably going to take a week or two. Kiev falls, and it's sort of all over with. Here we are, 6+ months after that, and we're in the midst of basically a war of attrition, it seems like. And so certainly this whole backdrop has caught our team here by surprise, not expecting any of this to happen. So a couple of things. Obviously, the big one is going to be the commodity shock, right? The oil and natural gas side of the equation. Again, the U.S. is fairly insulated from that because we're largely self-sufficient. It's the places of the world where they're not self-sufficient, where they're reliant on energy imports to basically drive the economy. And as you mentioned, Europe is square in the bullseye for that backdrop. And a couple of things there to think about. Europe's getting hit by a double whammy right now, right? Europe is a highly export-driven economy. U.S. is not. If you think about exports in the U.S. as a percentage of our GDP, it's only about 12%. You go to someone like Germany, it's about 40%. So you can see how that backdrop for international trade is really a big deal. So if you think about the global tightening that we're seeing and the economies around the world slowing, from an export generation or an export engine growth driver, Europe's really in a tough bind there because you're basically going to be looking to export other people's growth. And if the entire global economy is decelerating, there's no growth to import from Germany's standpoint. So they're going to get hit by that front. And then on top of it, Germany and for the larger European Union backdrop, they're energy dependent, so they're importing. And so as these prices of natural gas and oil are skyrocketing, their terms of trade really gets hit, right? They're paying more for the price of what they need to import, and they're basically trying to export to their products for on the growth side, and the global economy is slowing. So they're getting hit on both sides of that equation. And a lot of that transmission mechanism is showing up in the euro, right? We're continuing to see the euro just trade south, parity. It broke through parity. It's sitting around parity. And that goes back to your dollar comment here. Listen, there are a couple of things to think about. Germany is certainly, or the European backdrop, the European economies have certainly transitioned as aggressively as they could, given the backdrop here. They're finding alternative sources of energy. They're finding alternative substitutes for natural gas, which had been largely coming out of Russia. They're getting them from other places. That I think it probably staves off maybe the worst case scenario in the near term. But this is going to be a recurring cycle. And so this probably just raises the issue again for next year. Where are they going to start tapping all this natural gas from? So what we've simply seen is, Asia is probably not getting the amount of exports they usually get on that front because they're being diverted to Europe. So you're just kind of shuffling the deck. The problem still exists. It doesn't go away. So while we may get through this year, and especially this winter cycle, with maybe modest damage, the problem is the issues are still out there and they're not going away anytime soon. So this is going to be a lingering, I think, headwind for Europe for quite some time. And it's certainly going to be the interim right now. Governments are basically putting a cap on prices for the households. Someone's got to pay that bill. It's basically the government. How does the government pay for that? They're going to have to issue debt. Is this the right time for basically an increase in European debt? Probably not. That's always been an issue going forward. So very, very tricky situation for Europe. And as we think about the dollar, we think of it as a smile, right? Think of you've got sort of the dimple, and then the smile in between. When the dollar outperforms or when the dollar stays strong, it's when either the U.S. growth backdrop is very, very much better, very much stronger than everybody else in the world, U.S. exceptionalism, or the global economy is so scared that everybody's running for basically safe haven assets, which tend to be dollar denominated. So you're going to bid up dollars. So in the extreme scenarios, U.S. is the best growth backdrop out there, or everybody's basically worried about the world imploding. I want to run a safe haven assets. The dollar does fine. It's when you get to that happy medium where everybody's growing and risk appetite's increasing. That's when the dollar basically does not tend to outperform, and you start to see the non-dollar assets perform. I'm not sure we're going to see anything in the near term change to address that backdrop. I would say two things. If either the Fed moves to a dovish pivot or China begins to stimulate aggressively, those are probably the two catalysts where I would see a dollar strength popping back up or a dollar weakness popping back up. But I put those as low probability events right now. So probably a strong dollar persists, and the growth backdrop and the recession risks in Europe are going to linger at least for probably into next year.
In the event that they were to come to agreement in Ukraine and Russia, do you guys you say, hey, that could be a 5% move or 10%, or at this point, you're really thinking about that?
So the trick on that one, it's, I think at the end of the day, people are going to be looking, the heads of state are going to be looking for a regime change in Russia. So we sort of play out the scenarios in terms of getting to a sort of an end to this, right? It's easy for the Europeans to push for this because Europe's not really supplying a lot of the military backdrop for Ukraine, right? A lot of that's coming out of the U.S. And when you talk about Zelensky, right, he's basically saying he's not giving up an ounce of land. So it doesn't seem like they're willing to budge in the interim. I'm not sure how much leverage Europe has because a lot of the military hardware is basically coming from the U.S. So even if the Europeans say, listen, we want to force you into a peace agreement, and if you don't, we're going to cut you off on the military side. I'm not sure how much teeth that has. Flip side is I'm not sure Putin wants to back down because, that's just not a good exit strategy for him at this point. He's kind of reaped his bed and he's going to have to live with it. And that's a backdrop that I think is going to be tough for him to back down on. So, we could see certainly a peace agreement, but I'm still thinking at the end of the day here, that's a low probability event. We're still looking at, probably a prolonged conflict where either one of two things happens, right? It gets escalated on the Russian side because they want to make this, put even more an emphasis on trying to defeat Ukraine, and Ukraine's going to try to take back their territory. They're not just willing to sort of keep the status quo where things stand today. They're trying to take back Crimea and, go through the whole 9 yards in terms of that southern border, the southeastern border. Low probability event, unfortunately.
I guess transitioning to the other elephant, which would be China. How are you guys looking at the opportunity in their markets? I know the tech sector in general has gotten hammered there. And then how do you guys think about the future dialogue between us and China? It seems like we're on quite a collision course. So and Taiwan continues to get even hotter. So how are you guys thinking about the opportunity and investing in that space, and then how we deal with the global issues?
Yeah, China's going to become, I think, a lingering concern for quite some time. Right, the Biden administration has had some chances to sort of tone the rhetoric down. Certainly haven't. If you watch the 60-minute interview over the weekend, went in the exact opposite direction with Taiwan, where they came out and basically said, they're willing to, or the U.S. is willing to commit troops. So, it's certainly no backing down on the rhetoric front. And I think that backdrop is going to persist. You're also seeing a little bit of a shift coming out of Europe too. I think Germany, who had sort of been trying to basically remain fairly neutral on this backdrop, with the new government in place there, I think they've certainly become a little bit more hawkish on China as well. So the confrontation on the geopolitical front with China, I think, is going to persist for quite some time. And the backdrop with China is going to continue to sort of be a problem on the economic front. You still have got zero COVID. You've got some concerns on the real estate sector side. And they're pretty much loath to, I think, re-stimulate the economy because they've attempted to deleverage over the last couple of years. And in order to jumpstart the economy, you're going to have to undo some of those policy changes that's put into place. And basically, it's going to be one step forward, two steps back. It might even be four steps back in this case. So there's a lot of different cross currents there that I think are going to make that China backdrop very challenging. And, at this point, you heard a lot of people saying China's uninvestable. When we look at a lot of those capital flows, nothing's really picked up in the interim. And so maybe there is some teeth to the argument here that people are saying, I've had it, I'm not going to bother anymore. They're just stepping away from the Chinese market. That does present some opportunities because, a lot of these valuations and companies have been beaten up so much. But flip side is you got to have other people come in and basically have that same view to push prices higher. I'm not sure if there's enough of that out there at right now. So, we've taken a step back. We've actually had an underweight going into the beginning of the year with EM. We actually added a little bit to China about 3 months ago. That has proven to be the wrong call for us. And we've actually unwound that position and said, we're just going to step this aside. And, our whole impetus was zero COVID probably starts to fade away and we get a little bit more of aggressive stimulus package. Neither of those two really happened. And so we're stepping back. The last piece I would make on the China-Taiwan front, this is obviously going to be one of the key political risks that will continue to overhang the markets for quite some time. I think what we saw from a response with Russia and Ukraine is sending a very strong message, right? So if you think about China and Taiwan, China has basically gone along the idea of we're not going to force integration with Taiwan as long as Taiwan doesn't try to force independence. So it's sort of like this happy medium where if you guys don't really pull farther away from us, we're not going to try to pull you closer to us sort of thing. We can coexist. But if we go to the worst case scenario where China does sort of say, we want to take Taiwan back, there's a couple of things I would point out. And it's a little bit on the sort of over the top aggressive side, but I think it hammers the point home, right? In order for China to take over Taiwan, you'd have to have an onslaught of a full launched invasion, right? And the problem with that, you're probably going to basically destroy everything on the island of Taiwan. And there's a lot of reasons why you wouldn't want to do that from a Chinese perspective, and think just the semiconductor production, right? I mean, you basically blow all of that up. Those are some crown jewels on the economic front that you no longer have, and that's something you just don't suddenly able to flip the switch and build it up. And you're probably also going to get a lot of brain drain, right? If China ends up invading Taiwan, a lot of those the Taiwanese intellectual capital, that's going to probably leave the country as well. So you're going to lose some of the things you really want. The second one, though, is if they just simply go with the blockade effect. I think you've already seen, based on what the financial community has been able to do with Russia, which is effectively shut them off from the banking system because everything's largely dollar denominated. You're going to see that happen with China as well. And I don't think China's in a situation where they can completely work their way around the dollar-based global financial system. They're still highly ingrained into that. So I think those two pieces make it a little bit of a challenge for any sort of military intervention with Taiwan. And as a result, my guess is a lot of saber rattling, but we're going to still coexist in sort of the idea of, as long as you guys don't push for independence, we're not going to push to absorb you in, and we'll go from there.
Do you feel like China's already taking those steps to try to decouple from the dollar? I mean, with their digital yuan and trying to force these oil producing nations to trade in that.
Yeah, and they're trying to. It's going to take a long time for, I think, them to get to a point where they're comfortable completely abandoning the dollar-based system. I think there's just too much international trade that goes on with the dollar. And it's going to be quite, I'm guessing we're talking decades before the dollar gets dethroned by renminbi, for example. That's a long way away, but that's what they're going to try to work to, obviously. Anytime you can sort of decentralize one currency, because we've already seen we can weaponize the dollar in here and the side effects from that. It's going to behoove a lot of these sort of competing countries to move away from it, but that takes a long time.
Mm-hmm. So as we finish up here for a final couple minutes, we spoke a little bit about Russia, Ukraine, China, and U.S. markets. Where do you mentioned being underweight EM. Where do you guys see the most opportunity? We're talking U.S. markets, and then if we maybe to dial that a little bit deeper, would you say more to the growth value? Where, fundamentally, where do you guys, target over call the next year to find most opportunity?
Yeah, and this goes back to the sort of, it's the nicest house on a tough block sort of thing, right? And I think that still lends itself to being invested in the United States. And we think of sort of the market in terms of risk cycles. We need to have investor risk appetite to, I think, help move that investor base outside of the U.S. So think of it as concentric circles, right? At the heart of the matter, where you're most comfortable, you're going to always have that U.S. exposure. As you get more comfortable with the global backdrop, it might be that simply, more supportive central bank policy, more supportive fiscal policy, growth is increasing. Then you become a little bit more risk-seeking. And when you become risk-seeking, you tend to move to non-dollar assets, which would then be international developed. And then if you're really risk-on, then you move to the emerging market spectrum. I think we're still quite a ways away from that backdrop. So I think for the interim, the near term, it's still a U.S.-centric portfolio that we focus on. And then from the tilts within that portfolio, you mentioned the growth value backdrop. I think of things in this is probably an oversimplistic backdrop, but I think it gets the point across. The market wants to always bid up what is scarce. And so think of it, what's scarce, growth or value? Well, in today's environment, right, we're seeing the economy slowing. Growth suddenly becomes scarce. And as a result, the market will bid up growth. What's the best way to sort of think about that? Well, it's the interest rate backdrop, right? So as interest rates are going up, you'd think that the growth backdrop is improving. And as a result, growth is abundant, so you want to bid up value. So hence, when interest rates are rising, value tends to do better because the idea of growth, interest rates equals what's abundant. So let's talk about what we're seeing right now. Interest rates are going up, hence the bid for value. I think once we hit that terminal rate and we sort of get that backdrop settling in, what's going to be scarce? Well, growth is going to be scarce at that point. Rates probably going to start to come back down. Yeah. That's probably the time you're going to then pivot back to growth. So as rates push higher, value, once we hit that terminal rate and then we start to settle in and probably start to see rates come back down, growth is going to become scarce, and that's where the market's going to bid up growth. So are we at that point where you want to switch from value to growth? Not yet. You can start dipping your toes in because we're getting close in terms of that peak in the Fed rate. But it's a timing issue. As I always say, I can get timing or direction right. I usually don't get either one of them, or I usually don't get both of them right. I get lucky if I did. I think we're still a little bit more in terms of waiting for that pivot to hit and where we swap back into growth. But
I think I think, and you also just hit on a great point. It's really hard to time these things perfectly. That's certainly why we do stress, looking at strategies around dollar cost averaging, being at 3,800 on the S&P 500, hard to say whether we hit the 3,600. I mean, we could certainly, have a Fed transition in the next month or two. More than not likely we'll get there. But, when you're dollar cost averaging, you're taking a lot of that volatility out of the market. So I think, so Jack, I definitely appreciate you giving us this overview from a macro perspective. It was very, very helpful. So, for the folks listening, certainly thank you for joining. And Jack, thank you for providing all this awesome insight. I think it was very, very helpful.
Yeah, my pleasure. Appreciate you inviting me on.
All right. Thank you today. Appreciate it. Have a wonderful day, everybody. Take care.
Take care.